It started quietly, the way most revolutions do. No gunfire, no impassioned speeches. Just 7 men, traveling under fake names, boarding a private train in the dead of a New Jersey winter back in 1910. Destination was a secret, a secluded island off the coast of Georgia named Jekyll Island. These weren't your average bankers or politicians. These were the titans of finance men representing the vast fortunes of J.P. Morgan, the Rockefellers, and the Rothschilds. Combined, they controlled a staggering portion of the world's wealth. Yet, their clandestine journey went completely unnoticed. Not a single newspaper reported it. Not one person in Congress had a clue. They even instructed the train staff to call them by fake titles, pretending to be nothing more than a group of duck hunters on a holiday retreat. For 9 straight days, hidden away in a luxurious, isolated clubhouse, they hammered out a plan. This wasn't just any plan. It was a blueprint designed to quietly transfer control of America's entire money supply from the hands of the public to a private banking cartel. The name they gave this creation? The Federal Reserve. 3 years later, in 1913, while most of Congress was home for the Christmas holidays, the bill was quietly pushed through. The Federal Reserve Act became law. And just like that, with the simple stroke of a pen, the United States handed over the sovereign power to create and control its money. Not to the government, and certainly not to the people, but to a small group of private bankers. That, my friends, was the real American Revolution, the one they conveniently forgot to teach you in school. Because from that moment on, every single dollar that came into existence would carry a hidden price tag: debt. The U.S. Constitution had explicitly granted Congress the power to coin money and regulate the value thereof. It was a foundational principle. But after 1913, that power was outsourced. The government would no longer print its own money directly. Instead, it would borrow it. The newly formed Federal Reserve would create dollars out of thin air, lend them to the U.S. government, and then charge interest on the loan. Just think about that for a second. Our entire monetary system began with a loan. It's a debt that can never, ever be fully repaid, because every new dollar is born already owing more than it's worth, thanks to interest. Here's the paradox. If by some miracle, every single debt in the country were paid off tomorrow, there will be no money left in circulation. Zero. The Founding Fathers saw this coming. Thomas Jefferson himself warned that allowing private banks to control the issuance of currency would be a greater threat to liberty than any standing army. But by the time those warnings resurfaced, it was too late. The system was already built, and it was designed to feed itself through an endless cycle of credit booms, inflationary busts, and devastating collapses. At first, it all seemed to work like a charm. The 1920s roared. Easy money, courtesy of the Fed, flooded the economy. The stock market soared to dizzying new heights. But when the time came for the bankers to call in their loans, the tide went out with terrifying speed, leaving millions of Americans financially stranded. The Great Depression wasn't some random accident of capitalism. It was a planned demolition, a reset. It was a massive consolidation of power and wealth. As thousands of small local banks failed, the big ones, the very institutions tied to the Federal Reserve, didn't just survive. They grew stronger, swallowing up their smaller competitors. This cycle became the blueprint for the next century. Inflate the money supply, let a bubble form, watch it crash, and then consolidate the assets. Every collapse methodically pulled more real wealth upward into the hands of the few who understood and controlled the game. In the decades that followed, the illusion only deepened. The American dollar, once as good as gold, was slowly and systematically severed from anything real or tangible. In 1933, President Franklin D. Roosevelt issued Executive Order 6102, which effectively confiscated gold from American citizens. Private ownership of gold bullion became illegal. People were forced to turn in their gold for paper dollars at a fixed rate. Then, almost immediately after, the government devalued that paper, gutting the savings of the very people who had trusted it. The people lost their wealth. The system kept theirs. By the end of World War II, America stood at the top of the global economy. The Bretton Woods Agreement in 1944 cemented the U.S. dollar as the world's reserve currency. Every other major nation pegged its money to the dollar. But there was still a promise holding it all together. Any country could redeem its dollars for gold at a fixed rate of $35 an ounce. Then came 1971. President Nixon, facing pressures from other countries demanding their gold, temporarily closed the gold window, ending the direct convertibility of dollars to gold. That temporary measure is still in effect today. Overnight, every currency in the world became fiat money backed by nothing but faith, government decree, and military might. From that day forward, money was no longer tied to value. It was tied to debt. And debt, unlike gold, can be created infinitely. The Federal Reserve had finally achieved the ultimate goal envisioned by those men on Jekyll Island decades earlier. They had created a system where money itself could be conjured from nothing, controlled completely by those who issue it, and repaid endlessly by the masses who are forced to use it. But to truly grasp how powerful this system is, you have to look under the hood and see how the machine actually works. The real genius isn't in a physical printing press. It's in the illusion of modern banking. When the Fed wants to stimulate the economy, it doesn't fire up the printers. It simply creates digital money, just numbers on a screen. It uses this new digital money to buy used treasury bonds from the largest commercial banks. Suddenly, these big banks are flush with fresh reserves. According to the rules of fractional reserve banking, they can then lend out many times that new amount to businesses, investors, and regular people like you and me. Every new loan they make creates new money in the system. And every loan payment that is made back to the bank effectively destroys that money. That's the secret alchemy of the modern world. Money isn't printed, it's lent into existence. And because every single dollar is created as a loan that must be repaid with interest, the system demands constant, perpetual growth. If the economy stops growing, defaults begin to cascade. If defaults rise, panic spreads. And when that panic hits, the Fed rides in as the savior, ready to save the system by, you guessed it, creating even more money. It's a feedback loop that can never end. It's a global treadmill that we can't step off of. Over the years, the crises have come and gone. The crashes of '87, the dot-com bubble of 2000, the financial meltdown of 2008, but every single one has followed the exact same pattern: expansion, speculation, collapse, bailout, and repeat. By 2008, the pattern had reached an absurd extreme. The housing market, built on a mountain of fraudulent loans, collapsed. But the banks that caused the crisis were deemed too big to fail. So, the Federal Reserve created trillions of dollars out of thin air to bail them out, buying their toxic assets and flooding the financial system with unprecedented liquidity. Wall Street was saved. Main Street was sold out. At that moment, the last pretense of free market capitalism quietly died. What replaced it is something I can only describe as monetary feudalism. We now live in a world where a central bank creates money, gives it directly to the financial elite, and everyone else is forced to rent their place in the system through a lifetime of perpetual debt. Between 2008 and 2020, the Fed's balance sheet exploded from under $1 trillion to nearly $7 trillion. During that same period, the stock market tripled and real estate prices doubled. Meanwhile, for the average person, wages barely budged. The rich, who owned the assets, got richer. Everyone else was left holding the bag, their purchasing power eaten away by the hidden tax of inflation. The illusion of prosperity was masterful, but it was all built on a foundation of digital air. And when the next crisis hit in 2020, the machine did what it was designed to do. It created money faster and in larger amounts than at any point in human history. The Federal Reserve took the unprecedented step of dropping the reserve requirement for banks to zero. That means, theoretically, banks could lend out infinite amounts of money without holding a single real dollar in reserve. That was the moment the system crossed into uncharted, dangerous territory. For the first time in history, the supply of money became truly mathematically unlimited. But when the supply of anything becomes infinite, its value approaches zero. The only question that remains is, who really benefits from this game? And who is paying the price? The answer, of course, is simple. Those closest to the money printer always win. When new money is created, it doesn't just rain down on everyone equally. No, it flows through the pipes of power straight into Wall Street, hedge funds, and the corporate giants who get their hands on it before prices adjust. By the time that money trickles down to ordinary people like us, everything costs more. This isn't an accident. It's by design. Economists even have a name for it: the Cantillon effect. Those who get the money early profit from inflation. Those who get it last, well, they pay for it. So when the Fed prints trillions of dollars, the headlines scream stimulus. But what it really is a massive wealth transfer, quiet, mathematical, and relentless. Think back to 2020, trillions were printed in just a few months. What happened? Asset prices exploded. The stock market hit record highs while millions of people lost their jobs and small businesses vanished. The billionaires who already owned the system added trillions more to their net worth. It wasn't a bailout of the economy. It was a bailout of the hierarchy. And sitting right at the top of that hierarchy is the Federal Reserve, a private institution, shielded from democratic oversight, with the power to create and destroy your purchasing power with a single keystroke. But here's where the machine turns truly sinister. Every single dollar created is borrowed into existence. That means the world's money supply is also the world's debt supply. To keep this system alive, the debt has to grow forever. And because debt grows much faster than productivity, The gap between the real economy and the financial one keeps stretching wider and wider. It's a mathematical certainty that the system must either inflate or collapse. So far, we've chosen inflation. But inflation does more than just raise prices. It erodes trust. It's a slow, invisible confiscation of your wealth. When your paycheck buys less and less each year, that's not just the market at work. That's the system harvesting your purchasing power to keep itself running. Governments borrow, the Fed prints, banks lend, consumers spend. Then prices rise, savings disappear, and the cycle repeats, each turn transferring a little more control upward. Meanwhile, the U.S. national debt has rocketed past $35 trillion. The interest payments alone now cost more than the entire defense budget. And still, the borrowing continues. Why? Because the moment it stops, the whole fragile structure collapses. So the Fed keeps printing, not to create prosperity, but to delay the inevitable reckoning. And yet, even as the money supply grows infinitely, the control becomes absolute. Because whoever controls the issuance of money controls behavior. They can raise interest rates and trigger a recession. They can lower them and flood markets with wild speculation. They can decide invisibly who suffers and who thrives. That power now extends far beyond our borders. The US dollar isn't just America's currency, it's the planet's operating system. Around 60% of all global trade is conducted in dollars. This means nearly every country on Earth has to hold dollar reserves just to buy oil, settle debts, or trade goods. When the Fed raises interest rates, global capital floods into dollars, crushing weaker currencies. When it prints, the dollar weakens, commodity prices spike, and nations that depend on imports suffer. Either way, the rest of the world is forced to play by America's monetary rules. This is the hidden empire, not built with soldiers and tanks, but with spreadsheets and algorithms. After World War II, the Bretton Woods Agreement made the dollar supreme. After 1971, when the dollar was cut loose from gold, that supremacy became pure fiat dominance. Oil-producing nations agreed to price their energy in dollars, creating the powerful petrodollar system. Any country that dared to break free like Libya or Iraq found itself facing sanctions or worse. That's not a conspiracy theory. That's the history of empire, updated for the digital age. While the world dances to the rhythm of the dollar, a darker truth is growing underneath. The derivatives market. This is a shadow financial world, now estimated at over $600 trillion in notional value. It's a mountain of bets on interest rates, currencies, and credit swaps, all stacked like dominoes. In 2008, this market almost destroyed everything. When mortgage derivatives imploded, one company, AIG, faced over $500 billion in exposure. The Fed had to step in with $182 billion to stop the chain reaction. 15 years later, the system is bigger than ever, and the same players are still holding the trigger. If one major bank fails today, the collapse wouldn't spread through tellers and vaults. It would happen at the speed of algorithms, with billions moving in milliseconds. That's how fragile our system has become. And yet, through it all, the same narrative persists. The Fed saved us. But the Fed never saves, it transfers. Losses get absorbed by the public through inflation, while the gains from every rescue get concentrated at the very top. Each crisis justifies more control, more intervention, and more dependency on the very institution that caused the problem in the first place. It is the genius of the design. The arsonist is also the one selling the fire insurance. So, where does this all end? History answers that question with chilling consistency. Every empire that divorced its currency from reality eventually collapsed under the weight of its own debt. Rome, Weimar Germany, Venezuela. The timeline changes, but the mathematics do not. When money loses its connection to real value, societies lose their connection to truth. Right now, the US faces an impossible choice. Either raise interest rates to fight inflation and risk crashing the entire economy, or keep rates low and let inflation silently destroy everyone's purchasing power. Either way, confidence erodes. And when confidence dies, so does the currency. The final phase of every fiat currency system is always the same: control. When trust fades, centralization grows. That's why the next step is already being prepared. Central bank digital currencies, or CBDCs. On paper, they promise efficiency and safety. In reality, they represent programmable money that can be tracked, that can expire, or that can be denied based on your behavior. It's the dream scenario for a system that already controls the supply of money. Now, it can control its usage too. And once that happens, our freedom becomes conditional. The truth is, the Federal Reserve secret isn't buried in the past. It's right here in front of us. The institution that was born in secrecy on Jekyll Island over a century ago still dictates the rhythm of the global economy. It creates every boom, every bust, every bailout, and every illusion of recovery. Its power isn't hidden, it's just been normalized. The money in your pocket isn't wealth, it's a claim on debt. Every number you see in every bank account is just borrowed time. And as the system expands, so does the distance between the people who produce value and the people who extract it. That's why understanding this isn't just about economics, it's about survival. Because when the next crisis comes, and it won't be about mortgage or stocks, it will be about trust itself. And once that trust finally breaks, the digital floodgates will open, offering solutions that will erase the last remnants of our financial independence. The Federal Reserve didn't just change America's money. It changed the very definition of reality, what we measure, what we value, and what we obey. The men who designed it knew one thing: the greatest form of control is the one people do ain't even see. And now, more than a century later, that control is nearly complete. The only question left is whether people will wake up before the final reset or sleepwalk right into it, holding paper promises from a system that was never built to serve them. Because the ultimate secret isn't that the Federal Reserve hides the truth. The secret is that it is the truth hiding in plain sight,